All right, let's try and make sense of what just happened on Wall Street. We had this really confusing day. I mean, the market finished way up, deep in the green, but somehow the whole week ended up in the red. So what on earth is going on?
Yeah, that's the big question, right? How can one day feel so good while the bigger picture, the whole week, was, well, a loss? We've got to break down this contradiction.
So if you just looked at Friday, you'd think things were fantastic. I mean, it was a strong rally, green everywhere you looked. But then you zoom out, and that's where you see the problem. For the whole week, the big indices were actually down. That snapped a pretty nice 3-week winning streak for both the S&P and the NASDAQ. So yeah, it was a really strong finish to a really weak week.
And we're not talking about a small jump here. The Dow, it closed up over 300 points. You can just imagine the screens flashing green, right? It gave everyone this feeling of really positive momentum going into the weekend. But, like I said, that's not the whole story. And get this, it wasn't just a handful of big tech stocks pulling everything up. Nope, the rally was incredibly broad. Just look at this. A full 85% of stocks in the S&P 500 were up. That's, well, it's a true sea of green. It shows you just how widespread the good mood was on Friday.
Okay, so what was behind all this? It was basically a classic economic tug-of-war. On one side, you've got some really strong data on personal spending. That suggests the consumer is still healthy, which is awesome news. But on the other side, there are these big dark clouds on the horizon. We're talking fears of a government shutdown and a massive jobs report coming next week that could change everything.
So with that whole picture in mind, let's dig into the specifics. First up, let's look at the day's big winners and figure out what was driving that surge.
All right, the biggest winner of the day, hands down, in the whole S&P 500, was the video game giant Electronic Arts, EA. The stock just went ballistic. It skyrocketed, jumping 15%, all because of some blockbuster news that broke.
So why the huge jump? Well, reports started flying that the company is getting really close to a massive deal, a deal to be taken private in what's called a leveraged buyout.
Okay, quick sidebar just so we're all on the same page. A leveraged buyout, an LBO, is basically when a company gets bought using a ton of borrowed money, usually by a private equity firm. The whole idea is to fix up the company behind the scenes, away from the public markets, and then, hopefully, sell it for a big profit down the road.
And the price tag we're talking about for this EA deal? A mind-blowing $50 billion. I mean, that is a number so big it could actually set a new record.
To give you some perspective on just how massive $50 billion is, let's see how it stacks up. It would be bigger than Elon Musk's $44 billion deal for Twitter. And it would even top the legendary KKR buyout of Nabisco back in the day, which was around $31 billion. So yeah, we are talking about a truly monumental deal here.
Okay, another big winner on the day was a company called Paccar. They make heavy-duty trucks, but their rally had nothing to do with buyout rumors. This one was all about a key policy announcement coming out of Washington.
So here's how it worked. It's a pretty simple cause and effect, really. The administration announced a new 25% tariff on imported heavy trucks. Now, since Paccar builds a ton of its trucks right here in the US, this new tax on their foreign competition, well, it's a direct shot in the arm for their business. And you can bet the market absolutely loved that news.
But you know how it goes. For every winner, there's got to be a loser. It wasn't all sunshine and rainbows. So let's flip the script now and take a look at the companies that had a rough day.
And on Friday, the title for biggest loser in the S&P 500 went to a name we all know, Costco. Yep. The stock dropped almost 3%, which made it the single worst performer in the whole index.
So what happened? Why the big drop? Well, it all came down to one word: expectations. Costco put out a mixed earnings report. And look, some of the numbers were decent, but investors have priced that stock for perfection. The valuation is so high that expectations were through the roof. So when the report wasn't absolutely flawless, investors hit the sell button.
Hey, remember how we just talked about tariffs helping Paccar? Well, that sword cuts both ways. Shares of the high-end furniture store RH, you probably know them as Restoration Hardware, they took a tumble because of a whole different set of tariffs. And this is the perfect example of the other side of that coin. The administration announced new tariffs, this time on imported home goods, things like kitchen cabinets and vanities. And because RH's whole business model relies on importing products, these new taxes are a direct hit to their bottom line.
It's pretty wild, right? The exact same type of policy that sent one stock soaring sent another one plunging.
Okay, let's zoom out for a second, beyond the day-to-day stock tickers. All this chaos we're talking about, the tariffs, the economic uncertainty, it's not just moving stock prices. It might actually be changing who gets a seat at the table in corporate boardrooms. There's a really fascinating and kind of surprising trend emerging that we need to talk about.
This headline from Bloomberg really jumped out. It says, "White men are making a comeback in American corporate boardrooms." Now, think about that. After years of this huge, sustained push for more diversity on corporate boards, that trend seems to be going in reverse, and it's happening at the biggest companies in the country.
And the data behind it is, well, it's pretty stark. For the first time since 2017, the majority of new directors being appointed to S&P 500 boards are white men. That is a crystal clear reversal of a trend that's been going on for years. So the question is, what's causing such a big shift?
Well, according to interviews with directors and executive recruiters, the answer comes back to the uncertain times we're living in. With all the economic turmoil and political risks, like the tariffs we've been talking about, boards are apparently prioritizing one thing above everything else: CEO-level experience. They want people who've been through crises before, who've navigated these kinds of choppy waters. And it seems that search is leading them back to a more traditional pool of candidates.
And so that leaves us with a really big, thought-provoking question, doesn't it? In these turbulent times, as companies are staring down all these economic and political headwinds, are they now making a conscious choice, valuing that battle-tested experience over the push for more diversity in the boardroom? It's a really critical trend, and for sure one to keep an eye on.